Welcome back to AlgoBot, the channel where we take apart automated trading strategies and explore the ideas that drive them. I'm your host here at AlgoBot, and today we're studying an expert advisor for MetaTrader 5 called Traders Dynamic Index Shift. This one is built around the Traders Dynamic Index, a compound oscillator originally designed by Dean Malone, and it approaches the market in a momentum style. Over the next few minutes, you'll learn how the strategy reads momentum, how it quietly steps aside when the market goes flat, and exactly how it decides to enter and to exit. Remember, everything here is educational information only, so let's dive in and see how it thinks. Let's start with the big picture. Traders Dynamic Index Shift is a momentum shift system, and its defining idea is that every single component is measured on the relative strength index series itself, rather than on raw price. In other words, this is an indicator built on top of an indicator. The strategy first calculates a standard RSI, and then it layers several moving averages and a volatility measure directly on top of that RSI stream. That's what makes it deliberately different from a plain RSI level or divergence system. The Traders Dynamic Index gives us 4 lines, all derived from that one RSI stream. There's a fast green signal line, which is a short average of the RSI and reacts quickly. There's a slower red confirmation line, which smooths the RSI. There's a baseline, sometimes called the market baseline, which acts as the RSI's own mean or regime anchor. And finally, there are volatility bands, drawn a set number of standard deviations above and below that baseline. The distance between the upper and lower band, the bandwidth, tells us how active or how quiet momentum has become. The strategy is designed for trending instruments, with the notes suggesting a major foreign exchange pair such as euro against the US dollar or the British pound against the US dollar on the 15-minute up to the 1-hour time frame. It suits a trader who thinks in terms of momentum shifts, someone who wants to participate when a genuine move is developing and to sit patiently on the sidelines when the market is simply drifting. Because the risk is sized using the average true range, the approach naturally scales to whatever symbol and time frame you place it on. As always, this is an educational breakdown of how the code behaves, not a recommendation and not a promise of any outcome. Trading carries real risk, and losing trades are part of every strategy. Now let's walk through the exact logic, step by step. The expert advisor only evaluates its rules once per newly closed bar, so it is patient and it never reacts to a half-formed candle. Before it even considers a trade, it checks 2 housekeeping conditions. First, if a position is already open under its magic number, it stands aside because it holds only one position at a time and lets the bracket manage the exit. Second, if the current spread is wider than the maximum allowed points, it skips the bar to avoid trading in poor conditions. Once those checks pass, the strategy measures its 4 traders' dynamic index values on the just closed bar and on the bar before it. This lets it detect both a crossover and a slope. It then computes the bandwidth, which is 2 times the band's standard deviation multiple, times the standard deviation of the RSI over the baseline period. If that bandwidth is below the minimum threshold, which defaults to 12, the strategy concludes that momentum is too quiet, and it simply waits. This single condition is what keeps it out of the flat, low-conviction markets where lone oscillator crosses get chopped to pieces. For a long signal, things must line up on the same closed bar. The fast green line must cross above the slow red line. The green line must sit above the signal level, which defaults to 50, confirming momentum is on the bullish side of the midline. The baseline must be rising, showing the RSI's own regime agrees. And the bands must be sufficiently expanded. When all 4 agree, the strategy signals a buy. A short signal is the mirror image. The green line crosses below the red line. The green line sits below the 50 midline. The baseline is falling, and the bands are expanded. When those align, the strategy signals a sell. Risk is handled with the average true range. The stop loss is placed a multiple of ATR away from entry, using the stop multiplier that defaults to 1.5. The take profit is then set at the reward ratio, defaulting to 1.8, multiplied by that stop distance. So the intended reward is larger than the risk on each trade, though of course neither level is ever guaranteed to be reached. Let's read through the code as it appears in MetaEditor. At the top we have the input parameters. RsiPeriod, defaulting to 13, is the base length that feeds every trader's dynamic index line. Fast signal and slow signal, set to 2 and 7, define the green and red moving averages of that RSI. Band period, 34, sets the length of the baseline and the volatility bands, while band standard multiple and bandwidth minimum control how wide the bands must open before a trade is allowed. Signal level is the 50 midline. AtrPeriod, stop multiple, and reward ratio govern the risk. And there's also a maximum spread filter, a fixed lot size, and a magic number. Now look at the long block on screen. The condition reads, if cross-up is true, and green now is greater than the signal level, and the baseline now is greater than or equal to its previous value. That's the green line crossing above red, above the midline, with a rising baseline. When it's true, the entry is taken at the ask. The stop loss is the entry minus the risk distance, and the take profit is the entry plus the reward ratio times that same risk. Then trade up buy is called. The short block below is the exact mirror. If cross down is true, green now is below the signal level, and the baseline is falling, the entry is taken at the bid. The stop sits above entry, the target sits below by the reward ratio, and trade.sell places the order. Let's bring the logic to life on this illustration. In the lower panel, you can see the trader's dynamic index, with the fast green line, the smoother red line, the golden baseline, and the dashed signal level at 50 running across the middle. Watch how these lines behave as the candles form, because they, not the price, are what the strategy is reading. Look at the first two candles. Price is drifting lower, and in the panel below, the green line is sinking beneath the red line and beneath the 50 midline. Momentum is on the soft side, so the strategy simply watches. On the third candle, notice the shift. Price prints a strong bullish candle, and in the panel the fast green line swings sharply upward and crosses above the slow red line. At that same moment, the green line pushes above the 50 midline, and the golden baseline has just turned up, sloping in our favor. On top of that, the bands around the baseline have opened up, so the bandwidth requirement is satisfied. All four conditions align on this one closed bar, and that's where you see the buy entry marker appear. From there, the fourth, fifth, and sixth candles extend the move higher, each one closing above the last. The green line stays above the red, confirming momentum is intact. By the sixth candle, price reaches the take profit level, which was set at 1.8 times the initial stop distance measured from the average true range. The long idea has played out, and the target is met, so that position closes. Now watch what happens next, because this is the part traders often misread. On the seventh and eighth candles, price stalls near its peak and begins to roll over. Importantly, the strategy does not try to pick the exact top. It waits. Only on the ninth candle, once the fast green line has crossed back down through the red line and dropped below the 50 midline, with the golden baseline now sloping downward and the bands still wide, do all the short conditions come together. That's where the sell entry marker prints. The delay is deliberate. By demanding the crossover, the midline side, the falling baseline, and expanded volatility all at once, the strategy trades the confirmed downshift rather than a hopeful guess at the high. Follow the final candles. The 10th and 11th push to a fresh low as momentum carries the move down. The green line stays below the red, and price reaches the short take profit, again placed at the reward ratio of 1.8 times the stop distance. The second target is met, and that trade is complete. So across this whole sequence, the pattern is consistent. The green and red crossover on the RSI supplies the signal. The 50 midline and the baseline slope confirm the direction, and the volatility bands make sure a real move is underway before any order is placed. Of course, on a live chart, not every setup reaches its target, and losing trades do occur. This walkthrough simply shows how the rules are meant to behave. And that brings us to the end of our breakdown of traders' dynamic index shift. We saw how it builds the trader's dynamic index on top of the RSI itself, how the green and red crossover generates the signal, how the 50 midline and the sloping baseline confirm the direction, and how the volatility bands keep it out of quiet, choppy markets. We also covered how the average true range sizes the stop and how the reward ratio sets the target. Everything in this video is educational information only, and it is not financial advice, not a recommendation, and not a solicitation to trade. If you enjoyed this analysis, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment telling us which strategy we should study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.